A derivative is a financial agreement that derives its value from an underlying asset, such as oil, wheat, or a market variable like interest rates. These contracts facilitate a trade between two distinct groups. Hedgers, like farmers or airlines, use derivatives to shed the price risks they face in their daily operations. Speculators step in to accept that risk, betting they can profit from future price movements. Through this interaction, the derivative shifts the burden of price uncertainty away from the business and onto the speculator. Locking in a future price usually happens through one of two methods. A forward contract is a private, customized agreement between two parties. A futures contract performs the same function, but uses standardized terms and trades on a public exchange. Suppose a wheat farmer fears that crop prices will fall before harvest. They take a short position, selling a futures contract to lock in their selling price now. At the same time, a cereal company fearing a price spike takes a long position, buying a contract to lock in their future costs. Both parties are using the same market to protect their specific business operations and establish a predictable baseline for their costs and revenues. Futures traders use a margin deposit to control massive positions. A $5,000 deposit commands $100,000 of commodities. Because it is so large, a 2% adverse move creates a $2,000 penalty. This results in a 40% loss of deposited capital. This level of leverage creates extreme volatility for the trader. Small fluctuations in the underlying asset can rapidly deplete an investor's cash reserves. While futures create a strict obligation to trade, options provide the right to trade without the requirement to do so. A call option gives you the right to buy at a set strike price, and a put option gives you the right to sell. You pay an upfront premium to secure this choice. This chart illustrates the behavior of a put option. The flat line on the right represents your maximum loss, limited to the premium you paid. As the asset price falls below your strike price, the option's value rises, creating a floor for losses. Imagine you own a stock currently valued at $100. You buy a put with a $95 strike for a $5 premium. If the stock crashes to $60, what is your net profit on the put, and what is your total net loss? Pause here to calculate. The put allows you to sell a $60 stock for $95, creating a $35 payoff. After subtracting your $5 premium, your net profit on the option is $30. Looking at your entire portfolio, your stock lost $40 in value. However, the $30 gain from your option offsets most of that, leaving you with a total net loss of just $10. This outcome demonstrates how options function as insurance. By paying the upfront premium, you accept a small, certain loss to prevent a catastrophic one. The cost of an option is determined by its intrinsic value, what it's worth if used today, plus its time value. The more time remaining and the higher the market volatility, the more you will pay for the possibility of a profitable price swing. A swap allows two parties to exchange payment streams based on a reference amount called the notional. In an interest rate swap, the $1 million principal never changes hands. Instead, a company agrees to pay a fixed 5% rate, while a bank pays a floating rate, which we will set at 6%. At year-end, the company owes a fixed $50,000. The bank owes the floating rate of $60,000. Only the $10,000 difference is actually paid, moving from the bank to the company to settle the agreement. This exchange allows the company to convert floating rate debt into a fixed obligation, protecting them from rising interest rates without altering their original loan. These same principles apply to credit default swaps, which transfer the risk of a borrower defaulting, acting as a form of insurance on a bond or loan. These three instruments serve distinct roles. Futures establish hard obligations, options provide protective rights like insurance, and swaps allow for the exchange of ongoing cash flows. Derivatives function as a delivery system for risk, moving it away from those who need stability and into the hands of those willing to speculate. While they enable businesses to plan with confidence, their inherent leverage can also concentrate and magnify losses for the unprepared. This video is for educational purposes only.